Hi everyone, I'm Atuksha from Simple Crowdfunding, and in today's interview I'm here with the lovely Kwasi Affum, who's the person behind the Slow Money community, if you've come across it on Facebook, and also he's a strategist working for the investment banking arm of Barclays. Thank you so much for joining me today, Kwasi.
Thank you very much for having me, more importantly.
Kwasi, some of the people listening to this podcast or this interview may not actually know who you are and what your background is. Can I just ask you to share your journey and where you are today and what your main focus is in more detail?
I'd love to, yeah. So my name's Kwasi. As Atuksha mentioned, I founded Slow Money Club. And I think Slow Money is basically a community that we put together in order to share and syndicate information in a mix of financial analysis, economic analysis, and looking at property. So that's one of the things that I do. We have the Slow Money Club on Facebook, slowmoneyclub.com, Slow Money Podcast, and the YouTube. Separate to that, I'm also a property investor, and I focus mainly in London, and I focus mainly in the shared housing market. So houses of multiple occupation and co-living properties. And I also happen to work in investment banking, as you said. I'm work in strategy. I do impact assessment and advise on strategy for investment banks. Hopefully that makes sense.
Absolutely, for sure. And just for the listeners, I wanted to get Kwasi on in terms of, I wanted to speak to Kwasi and interview Kwasi because Kwasi, you mentioned especially on the slow money side, that you provide financial and economic analysis, but you then tie that into what's happening in property because you obviously have an interest in property as well. So for people who may be new to this, can you first explain what those two terms mean, and then we can start talking about how that's affecting or what's happening in the marketplace currently?
Yeah, sure. So what we do effectively, like I say, information analysis, helping businesses and individuals really understand how things that are going on within the economy and within the fiscal side, so financial things that the government are doing, within the monetary side, so stuff that is happening on around the Bank of England, etc., and then the impact on the broader individuals within the economy. So the way these things work, there's normally different orders of impact that occur when you have an event. And so whatever it is, it might be, we could take COVID, for example. And so COVID, for example, is something that looking at professionally and strategically, I started looking at probably in January. And in January, you can see a lot of the first order impacts we were hypothesizing were around things like disruption to supply chains, to businesses and sectors that operate mainly within China or within the Wuhan province of China specifically, and that's more of a first order impact. But even back then, you could kind of project that this would have broader global consequences because, for example, even back then we knew that a lot of the pharmaceutical industry was based in Wuhan. It would probably impact their supply, which we thought could impact that sector going on into the latter part of the year. Obviously, we didn't know what was going to happen as it's transpired, but yeah, so that's kind of an element of what the analysis looks like, what strategy looks like. And effectively, what I do is similar because I'm in property, so I have a property business, and I look at my business in a similar way, looking at these macroeconomic as well as macro and microeconomic events, looking at the financial side, the fiscal side, and trying to extrapolate, see what that will look like in my own business. So it's a lot of that I share within this space. I guess to answer your question, that's what the definitions really break down into.
So Talking about the analysis, I actually want to take it back to 2019 first, because there was a lot of unsurety in the marketplace because of the lack of direction, I suppose. Excuse me, lack of direction from a political standpoint. And so towards the end of last year, what were you seeing in the market? And how was it affecting property?
Property in particular, I mean, I think towards the end of last year, the main threat was Brexit. The main thing that we were looking at, either in the economy, the main thing we were looking at was Brexit. We're also in property, it was going to be a question of what does that deal look like? Were we going to get something? What was going to happen at the end of Jan? What was the transition going to look like? And was there going to be a deal, no deal scenario again come the end of the year? Those are really the kind of key things that were on the horizon, both in property, and I think already also within property you had a lot of the tax changes which were starting to bite. That was a staggered thing that George Osborne had implemented, so the latter part of that regime was coming into effect. So all of those things were having impacts on the property market already. I think more broadly though, the economy was doing quite well. We had growth, unemployment was quite low, wage growth was quite high. So more broadly, at least from my perspective, looking at it from a tenant-based perspective, there was a decent amount of tailwinds, as we call them, to support that side of the market, albeit there were a number of headwinds that were potentially going to impact on the capital valuation side of things. So yeah, there wasn't any major concerns in particular for property other than the stuff that we've been seeing playing out in the previous sort of 12 to 18 months. But then COVID happened.
One of the things that we had noticed was, especially towards the end of last year, there were a number of sort of maybe larger, more expensive units, maybe in and around London, for example, where there was a lot of overseas money coming in before, but that was actually just put on hold, waiting for the Brexit decision, for sure, and also understanding what the political environment would look like. So as soon as the decision was made, as soon as the vote was taken in December, the market started moving again. So had you noticed that as a change as well, or was that, I suppose, more widely in the marketplace, was that just not a factor?
I think so there's two elements to this, and it's always interesting to look at the markets versus the economy versus even the property, which is kind of like a subsector. But the financial markets are normally forward-looking. So a lot of what happens, it tends to be typically factored in. And when it isn't, is when you get large corrections in the market and in the prices. So I think leading up to the election, the markets in particular were there was a bit of trepidation, should I say. After the vote, when the Tories won such a conclusive majority, there was a lot of positivity in the market. And so, as you say, a lot of money started flooding in. A lot of companies that have suffered in the previous 3 years, mainly companies that are based in Britain and only serve British customers mainly, actually, had suffered a lot. Financials, UK financial had suffered a lot. So money started rushing into those parts, those subsectors in the market, funny enough. The property sector, I don't think it suffered too much. It had in the final 12 months somewhat, but I don't think it had suffered too much as a result of Brexit. But to your point, the foreign direct investment side of property those taps started to loosen, and there seemed to be a bit of slow liquidity into the market from foreign direct investors. It's interesting, though, I think that towards the end of December, in the financial markets in particular, there was a lot of money on the sidelines again there, because a lot of the clever market participants were anticipating that we were at the phase in the cycle that we're at. So given the phase that we're in cycle that we're at, a lot of people who may be in strategy for investment banks would be advising that you don't possibly get into certain markets or certain types of businesses because we're due some kind of correction. You can never predict these things to a date, but these things also operate in cycles. So I think a lot of more sophisticated investors were aware of the fact that there was some kind of correction due and were possibly holding out of certain positions or holding a lot of liquidity. And we saw that, we could probably see that now in terms of the FTSE and how fast it's rebounded. So it's not necessarily the case that people lost money, it's probably people putting money back in.
Absolutely.
And similar in property, I think, if, once, especially now that we have the things have opened up again, I've been able to get valuations done on property. I don't know if that's a good thing, but at least the market is opening up again. I think once that starts again, there's going to be a lot of pent up demand that starts to loosen up. The liquidity is going to be the question. I think depending on, there will be money out there, but depending on the valuations that come back, depending on the risk appetite of valuers who are looking at these properties, that's going to determine the ability to lend or the ability to borrow, because LTVs are going to be the key question.
And that's a really interesting point. I'll come back to that one in a second. I just want to go back and talk about the market correction. And I've heard exactly the same. There were a lot of people who were expecting a market correction at some point in the first half of this year. It was just COVID wasn't how they expected it to happen. No one did. In terms of that correction, I suppose, the effect of COVID itself, do you think that has had more of an impact, or is it not as bad? Because in the UK in particular, because we've been through the challenges we've seen over the last couple of years, especially in relation to Brexit, the market was already subdued. What are your thoughts on that?
Yeah, that's a good question. I think one of the things that a lot of people were wondering before this or during this was whether it was like 2008 or what the similarities were. I think it's fair to say that every recession is different. But it's also the case that every recession is the same insofar as it usually involves some kind of exogenous shock to the system that is unexpected, in whether it's a financial crisis, whether it's a health crisis, whether it's a different type of crisis. I made a joke to someone recently that probably the next crisis would be an extraterrestrial crisis of aliens, because that's probably the thing that we least expect. So every recession is different, but they're all the same insofar as they're unexpected events. And this is definitely not like 2008. It's going to have a totally, well, maybe not totally, but it's going to have a different impact on the long term of the economy. This is something that people like Andrew Bailey, who's now the head of the Bank of England, have spoken about in terms of scarring and long-term scarring of the economy as a result of not just the virus itself, but some of the lockdown measures. Mm-hmm. So I guess to answer your question, that it wasn't expected, but there are also lots of companies toward the end of last year who anticipated where in the cycle we are, and we're probably had a lot of money on the sidelines in anticipation of some kind of downturn, given that we've been on an uptrend for so long. So I think a lot of these things are driven in banking, a lot of these things are driven by technicals, some of it is driven by fundamentals. The key thing is that across both of those, there were key indicators that illustrated that we were probably due some kind of correction. So yeah, I think it's not that it was expected, and it's not like 2008, but at the same time, we were in the part of the cycle where this could happen. And usually recessions involve an exogenous shock that nobody expected anyway.
And moving forwards then, obviously the longer term implications, because ultimately all the loans, the grants and everything else that's been made available, and the impact of lockdown, which we still don't know when we're going to come out of that. What's your view in terms of where you think the market will be heading, especially for the next, say, 6 months or a year, and what would you expect to happen during that time?
Yeah, that's a good question. Putting on my hat and looking in my crystal ball, I guess. I think that's what I talked about scarring. I think that's going to be really key. The good thing is a lot of the measures that the government took lockdown during the lockdown, things like furlough, bounce back loan, C-bills, all hopefully should support businesses so that we avoid one of the key things that could cause scarring, which is businesses failing. So if businesses fail and the economy permanently shrank, then there'll be a permanent loss of demand, which would have knock-on impact onto pretty much everything else. So that was good to try to reduce the number of businesses failing. But I think it goes without saying that some businesses will fail. The knock-on effect of that is unemployment and long-term unemployment, because if people are unemployed for a long period and are out of work for a long period, it makes it harder for them to get back into work. So I think that's a major risk to the economy if we start to get a sharp rise in unemployment, but also a rise in the long-term unemployed. Kind of connected to that is new jobs or new innovation and new things starting up. I think it's interesting to see actually that from today, the government's starting to do a lot more contact tracing. One of the new jobs that didn't exist probably a month ago is contact tracer. So now, there are people becoming unemployed, but there's also new jobs being created in the economy, such as contact tracers, which should kind of absorb some of the unemployment. We hope it's not going to be enough, I don't think, to absorb all of it, but there are new jobs. I think other things will include, you're going to have a lot more lab technicians doing tests, because you're going to have a lot more people being tested. Then there's things like offices and commercial office space and how those are going to be impacted by people working from home more. So within banking, a number of different people, including the CEO of Barclays, has said that the days of having 7,000 to 8,000 people in a central headquarters building are long gone. And I think that basically change happened overnight. I know that when some people were looking at the strategy for this back in March, that was one of the feedback points around probably we're not going to go back to everybody being in the office at the same time for a number of reasons. Even if we could, we probably wouldn't want to, because the use case has now proven that we don't need to. There's going to be people who don't want to go back because it's better for their family and lifestyle benefits, who maybe have always wanted to work from home full time but haven't been able to. So those people definitely won't go back, irrespective of what happens with the virus. It's going to be a show, so that's going to reduce the demand. I think the other, I mentioned earlier about first, second, and third order impact. When we're talking about the office space piece, that's probably a second order impact. I think a third order impact here would be things like, why do people, if people are working from home, why do they need to commute to work? So then actually places that were in demand, London locations that were within commute distance of the office, are now no longer that appealing, because you don't need to go to the office. Maybe you go to the office 2 days every 3 months. Maybe you stay overnight in a hotel instead of having to live there. And I know this actually because it's on a personal level, because I've got friends who live within inner London, have been locked down for 3 months or whatever, no garden, nowhere to go, in a 2-bed flat with 2 kids under 2. And they're seriously considering, when we unlock this, going as far out of London as possible. So there's going to be a lot of pent up demand in that kind of space as well. So yeah, I think there's going to be a lot of structural changes happening, not just in terms of whether things like restaurants, airlines, and office spaces, how they're impacted post-pandemic, but also just the kind of second and third order impacts of what does that then mean for the people who work in airlines, restaurants, offices. What does that then mean for the kind of markets that they support and the parts of the economy that they support? I think one really interesting stat actually is that for every £1 that a company spends, individuals spend about 7. So, that's really where the demand comes from, the economy, and it's going to be interesting to see how that pans out.
Yeah, and it's so true, isn't it? Because I think people have had the opportunity to not just test on a week or 2 weeks basis, but to actually test on 2 or 3 months. And it's habit forming as well, isn't it? So if you're then working from home, actually this all works fine. People who didn't have, or companies that didn't have infrastructure in place, probably have it in place now. And they've realized actually they can work from home. So it will potentially create a lot more empty office space available. And so it'll be interesting to see what happens on that basis. The other thing is obviously having outdoor spaces has become really important. And already there's an increased demand for properties that have got a decent amount of outdoor space. And that's already started. The other thing, talking to one of the, a very, very large buy-to-let landlord, he was saying that he's actually received lots of communications from his tenants asking if they can buy the properties they live in, because they've redone their calculations and actually they're spending less because they're not going out as much. And so actually we can potentially afford to buy a property. And so that's been really insightful as well, which is just some positives coming out of it, right? So that's a good thing.
Right. And I think that's exactly the way to look at it. There are, we're in a very bad situation globally, but as you say, to be honest, before the pandemic, I was commuting into the Canary Wharf area. I was also having networking, lunches, dinners, etc. I haven't been to a restaurant since the 24th of March. I've probably had 2 takeaways in that time, so I assume that other people are similar and people will be saving a lot of money. I haven't been saving money, I've just been blowing it on Amazon, but that's another story.
And then talking about the recovery aspect of it, one of the things, especially within property, is that there are a number of property companies who have taken out the bounce back loans, potentially CBIL loans, and are stocking that cash as such. They've banked it, right? So in terms of being able to repay that amount, do you think potentially, there is a challenge coming down the line because there will be a number of people who just can't repay these loans? That's my first part of the question. And the second is also then in relation to how will that potentially, or do you think it will potentially affect the ability for people to get finance moving forwards?
I think I can definitely see the default rate of these loans being higher than normal lending by banks because of some of the relaxation in the criteria. I mean, it's great. I think it's great that people have been bailed out in this way because it broadly helps the economy. But one of the mistakes people keep making is comparing this to bailing out the banks. The banks were bailed out because they're systematically important, as we're discovering now, because actually the banks are the ones doing things like facilitating these loans. The new thing about this is that it's guaranteed loans. So it's actually the bank's money that the government are underwriting. So again, this is the banking sector that's facilitating all these payments. This is the reason they were bailed out, so that they can do things like this, but actually because they do things like this on a daily basis. And that's where the term systematically important comes from. And I do think that the media in particular, it's interesting, back in 2008, we bankers were being vilified in the media and people were loving it. Now, though, when it's the politicians that are being vilified, it's quite interesting, the change in dynamic, because people seem to be blaming the media, which is really interesting to me. 2008, nobody was blaming the media. I was. I mean, back then I was young and just got into the industry, but the way this whole thing was being reported was wrong, and it was made up of everything that the media being accused of now applies to 2008. That's just my personal gripe out the way. But since then, obviously, a lot of the changes that have been made have meant that the banks are more structurally sound. this type of relaxation of the rules could impact if the default rate rises, could impact liquidity within the banks, could impact capital ratios, and could therefore have longer third, fourth order impact on the banking sector. I think also, I guess my fear is that there's going to be a high default rate, a high number of businesses failing in the next 3 to 5 years, as the ones that are been using this lifeblood run out of it. If you've called this a ventilator, it's going to stop soon. They're going to suffer as a result. And then that's going to again have a knock-on impact on other sectors. I mentioned the airline sector in the previous, or even the restaurant sector, pubs, you know, companies that are either lending to pubs or holding debt in these companies. That's the next order, that they could be impacted if their liquidity positions become into question. So to answer your question, I do see quite a bit of risk around the ease of lending and how it's been relaxed. It does remind me of pre-2007, if I'm honest. It seemed like everybody else has forgotten this period, including the people who are taking the loans. This is the other gripe maybe that I have. Back in 2007, 2008, the banks got all the blame for lending, but nobody blamed the people who took the money and what they did with the money or didn't do. And that's where we are now. I think people are happy to take the money. Nobody's thinking about what happens if it goes wrong. And in the future, I expect that the level of default for BB bounce back loan scheme and C-bills will be higher than general lending. What that means for GDP, because this is underwritten by the government, what that means for national debt, what that means for the then knock-on second, third, fourth order taxes, spending, all of those things, I guess is stuff that nobody's thinking about now. But as a strategist, this is the type of stuff that we have to be thinking about at the forefront. So that's literally where my head is. I feel that we are in a position where we're going to have to either have massive tax rises in the next 2 to 3 years. Before the end of this current parliament, we're going to have to see either massive tax rises or massive reduction in spending. And that's just basic kind of balancing equations, one side or the other. Question is, which way is it going to fall?
Yeah, and that's one of the other knock-on effects of that is also going to be if people do default and they lose their current livelihoods, then it will also be an additional drain on public services, won't it?
Exactly. And I think that's kind of the key thing, is that we're going to have the unemployment's going to be up. We know that already. We're going to have to spend a lot more on health. We know that already. We're going to probably have to spend a lot more on transport, because the demand for public transport is going to fall. So all of those spending increases tell me that we're probably going to be in a position where we need to generate extra revenue. We're also anticipating the GDP is going to fall. So based on our projections in January, we think we're going to be somewhere about 8% less, and we're talking in trillions. So 8% of a few trillion is a lot. So all of those things, all of those numbers need to add up at some point. And I don't think anybody's necessarily appreciating that. People are just happy with the fact that they've got a bounce back loan for 3 or 4 businesses and can go splash out, which is great. But we as a country are going to have to pay that back at some point.
Yeah, and with regards to the bounce back loans, one of my gripes is in relation to, it is so simple to get the loan, isn't it? And a lot of people don't fully understand that actually, unless it's declared correctly, they're potentially committing fraud. And the fact that the systems are all tied up at the back end, the fact is HMRC know how much you've been paying in taxes and all of that stuff. I don't think everyone's connecting the dots on that front. Is it something you've seen something different or the same, or what's your view?
One of the things that came in recently, regulation. So a large part of what I do in my work as well is looking at regulations and looking at what the impact is of those regulations, and then trying to determine whether or not there's a strategic opportunity there. One of the regulations that came in recently was something called Making Tax Digital, which everybody should be familiar with if they're a business owner. It's a series of, MTD is actually a series of different legislation coming in over time. But the upshot is, one element of MTD, for example, is that they want banks using open banking to provide information to HMRC on tax, or interest, or revenues. So they'd be able to match what the bank's telling them with what you're putting on your accounts with what you're putting in other places. Very soon, things like maybe versus what's in your bank account versus what's on a mortgage application. So this is really where the government wants to go to if you look at it more holistically in terms of big data, aggregation of data. Very soon they'll be doing things like applying artificial intelligence to this data so that they can process a lot more of this data and be able to tell the story much better. So, you know, this is what's going on. These things are happening. They're being trialed. They're being tested. Banks are working with governments on initiatives that are regulations. This is what's going on. I think people maybe should be more mindful and cognizant of the broader picture of the world that we operate in now. I think today as well, there's a new app that's coming out for contact tracing. This is the kind of world that we live in, where we're moving to a space where governments and around the world will collect more data on citizens, and then we use that data to aggregate in order to be able to either create certain behaviors, like getting people to isolate, or be able to track people to see who's got the virus and who they've been in contact with. But that's the world we live in, and it expands to things like your taxes, your the information that you put out there. But yeah, I think it's probably something that business owners in particular should be very cognizant of.
And with regards to finance moving forward, so, and we're talking about property here, do you foresee any challenges with regards to getting finance for, say, SME developers or larger developers, or is it going to be dependent upon sites? Some certain sites will be more popular than others, or certain types of development will be more popular than others. Have you got a view of any of that?
Yeah, I mean, I think firstly it depends on who the lender is. I think there's always a big difference for me between the kind of high street lenders, the lending arms of high street banks versus some of the more smaller lenders who have a different risk appetite. So that's always one way to cut it to begin with. And then I think the other element to look at is that if certain lenders already are overexposed to certain sectors or certain businesses in certain areas, they're going to be less likely to lend. Also, I think they're going to look more closely at tenant type, tenant mix, looking at it for commercial space in particular, looking at what they're really, who's really paying the leases. I think the other element is that there's also going to be commercial space that's in massive demand as a result of most of this. You're going to have places such as warehousing space. So as everything moves online, as the high street dies a faster death than was previously predicted, you're going to have a lot more warehousing space or demand for warehousing space, places like Amazon. So that type of commercial is probably going to boom. I mentioned earlier there's going to be a lot more demand for lab technicians. There's also going to be a lot more demand for lab space, something that was probably not been massively sought in this country as we outsourced things. So I think one of the things that's difficult for me, I guess, or one of the things that I bear in mind is a lot of what's going to happen in property is going to be directly influenced by what's going on in the broader macroeconomic environment. I think from personally, there's people who look at the financials and look at the technicals and will say that we're going to have a V-shaped recession because this is what the Bank of England scenario says, or this is what the OBR prediction says, reference case, the OBR reference case says. So but that's purely looking at it from a technical perspective. I think there's an element of fundamentals in this, which is people are ignoring the fact that companies' business models have probably changed fundamentally going forward, which isn't being fully appreciated. And then for me, the third element to it is unemployment. And so whether we talk about a V-shaped recession, a U-shaped recession, or whatever, I think that needs to square with the idea that we're going to have a sharp rise in unemployment, which is also the prediction. So maybe to take a step back, the Bank of England and the OBR have reference cases and scenarios which predict somewhat of a return to economic growth next year. Reduction in the first half of this year, growth in the second half of the year, but not enough to offset the loss in the first 2 quarters of the year. But I think what people may be ignoring is that this is the best case scenario. So both the reference case and the scenario by the Bank of England predicting about 8% GDP contraction, I think those are all best case scenarios. And if you look, probably a lot of the data shows that it's worse than those best case scenarios. Yes, I think from property perspective, for me, the thing to look out for is unemployment. That's really key, because in order for any kind of quick rebound to happen, in order for any kind of demand in the house buying side to remain, to retain strong rental demand in prices, yields, I think we need to really have relatively low unemployment, relatively short unemployment. Those are the things to look out for. That, to me, those are the things that will drive the shape of the recovery, whether in the economy or in property.
And what about valuations? Do you think, because again, or is that going to be tied to, let's see what happens on the unemployment front and then sort of take it from there? Or is it, there's a separate thread here and that valuations are going to get interesting? What's your view of that?
That's a great question. I do have a view on that, mainly because yesterday I had my first post-pandemic valuation report land in my inbox. So it's a bit of a raw topic, shall we say. So long story short, I was supposed to get this valuation done right before lockdown. Actually, on the day the lockdown started, it was booked for 9 a.m. on the 24th, I think. So it didn't happen, obviously. I then had to wait, and then when the government announced that building work can begin again, I contacted the lender. Unfortunately, the surveyor I'd already paid to do the survey wasn't working still, so I had to pay another surveyor to get the work done, or the survey done. I got the report back yesterday. So actually, as it turns out, the surveyor has devalued the property by about by about 75K since the last valuation in 2 years ago, about 28 months ago. He says in his report that he's reflecting pre-pandemic prices, but I don't understand how that's possible to have made. And I'm actually in the area where this property is, houses in that area have actually gone up about 18% in the period that I've owned the property. The value that he gave to the property is less than the average in the area over the last 2 years in terms of sales. So it's really interesting to me. I think 3 things really. Number one, a lot of valuers will be extremely pessimistic. They will want to protect their PI. Yeah. So they'll basically do both. I think he gave a price that reflects post-pandemic, but then caveated it by saying he hasn't reflected post-pandemic price, but that's exactly what he's done. I think we're going to see that a lot. I think that because of the lack of activity in the market, it's going to be very difficult to get open market values for remortgages in particular. So I think that's going to be really challenged, something that's going to be on the top of my list in terms of trying to resolve. And I think the third thing is going to be LTVs. So the values are going to be downwritten, in my opinion, but I think also 2, on top of that, when you come back with a lower LTV, with a lower value, they're going to offer you a lower LTV as well. So for example, in my case, the property originally they were going to lend, as well as reducing the value by 75K, they want to reduce the LTV from 65 to 60. So it's really a double hit. And, depending on the price of the property, it's quite a large amount. So yeah, that's my thoughts on valuations. I think that there's going to be a lot of properties being downwritten. There's going to be a lot of LTVs being going lower. And I think also, at least in my experience, all this stuff really always won't come out until the point where the valuations happen. They'll be happy to give you a mortgage offer in principle or whatever LTV, whatever valuation you give them. But I think it's very important to be mindful that you can go through this like I have, pay legals, pay multiple valuations, pay lots of other costs, solicitors' fees, and get to a point where actually you're 6 figures short of how much you actually wanted to get out or how much you need to refinance by. So yeah, that's my thoughts on valuations.
And one of the things I suppose is I appreciate interest rates really low at the moment. And there's a lot of people who would typically be wanting to refinance, but actually with potentially lower valuations and lower loan to values, it may not be possible to do. So in that regard, people may be stuck anyway because of the situation we're in. It's interesting actually, because one of the things we had sort of mentioned, I think probably even coming up to 7-8 weeks ago, was that because of this pandemic, we were expecting there to be a shortage of plasterboard and finishing plaster, and it's now hit. And so trying to get a hold of that is a challenge, right? But it's hopefully
multi-finish. I think there's a massive shortage of multi-finish. If you've got some multi-finish, let me know.
Well, it's available on eBay, I think, for 50 quid a bag or something. But
What?
it is possible to still get a hold of some. And I know a number of developers who actually just stocked up because they were expecting challenges. So that's a good thing. I think from a financial standpoint, there's a few things that we are keeping an eye on, and where we think there will potentially be challenges. One is on the actual valuations, and they are all coming with COVID clauses right now, which is not ideal either. So checking the paperwork is really, really important. But I know that the larger home builders and government as well are looking to see what can be done to make sure that valuations don't drop too much. So it might be a shorter term challenge in that regard. So that's the first thing. We've all seen drops in terms of loan to values, and it might be that going to a lender, if you were a property developer and going to the same lender for all your projects, it might not be feasible to do that anymore. So lenders may stop after sort of 2 or 3 and then say, okay, we're exposed now. Now we're not going to take on any more projects. So that's going to be interesting. And smaller sites, so where people are building sort of anything between 2 and I'd say sort of 15 units or thereabouts, getting funding for those will potentially become a little bit more challenging through traditional channels. So again, these are all the things that we're sort of keeping an eye out for in the coming months, because that if there are going to be sort of blocks, that's where we potentially see them. So
yeah, I agree. I think one of what I was thinking actually is that we have basically a 3 to 4 month period where it normally takes to complete property transactions. And so probably for now, a lot of the transactions that are going through were started before. It's going to be interesting to see the transactions that are going to be starting soon, how they pan out over the next 2 to 3 months.
yeah.
Because even for me, this refinance was something that was obviously started way before in order for it to be. So yeah, it's going to be interesting to see how the ones that are starting now, how those valuations are impacted going forward.
Yeah. So, and I suppose in terms of, so we won't know how this is all going to pan out. And at the moment, you mentioned before your crystal ball, and I think everyone's like looking for their crystal ball, which they've left in the office at work and they can't get to it, right? So, so we just have to wait and see where it goes. I suppose from a property standpoint, there is an opportunity, and that opportunity is to learn more about the marketplace and how market forces sit side by side with property. So, for example, we know that when property goes down, buying potentially gold and silver goes up. So, are there any other market forces that are, in some regard, follow a similar pattern to property, whether it goes up or down? When one goes up, the other goes down. Is there anything that you're seeing in the market that
It's a
ties
great
up
question.
property?
But I think so. Correlation, negative correlation is always interesting. But funny enough, one of the things that this current recession or downturn and recovery on the stock markets have shown is a lack of correlation. So you've had the markets going up at the same time as yields are dropping in treasury bills or bonds, which means that people are buying both, or conversely, you've had them both falling at the same time, which means that people are selling both commodities. Yeah, we had recently, there was a period where oil was falling, the stock market was falling, gold price was falling. So normally, historically, there's been, I think the reason for this is that we've gone through this period now of low inflation and ultra low interest rates. So this ultra low interest rate policy, monetary easing, quantitative easing, and low inflation has meant that historic correlation between assets has somewhat been broken. The lack of volatility that we've had for the last decade is also part of that. But yeah, I think even from a gold perspective now, this had become, the link was a lot closer in the past than it is now between the correlation between gold and, say, the stock market. When the stock markets would fall, commodity prices would typically rise. That used to be how it was. Or commodity prices would fall, the stock market would fall and government bond prices would go up and therefore the yield would go down. But that doesn't really happen anymore. And then you've got, on the other hand, you've got things like the 10-year. So you've got things like inversion, yield curve inversion, where longer dated bonds are trading as more expensive than shorter dated ones. So people will price in more risk into the future than into the present, which is just weird because normally you think things will sort themselves out in the future. So I guess, yeah, to the point, right now is probably the worst time to look at the correlations between assets because of the volatility that exists. I think as we get to the second half of the year, there's an index called VIX, which is used to kind of look at volatility. It rose to something like 80 plus, which is ridiculous considering it'd been at less than 10, about 7 for a decade. But it's still at 20, so it's still like a double what the historic average is. So which means there's still quite a lot of volatility in the market, even though it's not at the high that it was around 80 back in March. But yeah, I think once the volatility dies down, we'll start to see maybe some more correlation between things like property and the other element is REITs, of course, real estate investment trust, which are listed on the market. We see more correlation between the stock market, the REITs, the underlying properties, and some of the hedges that we talk about, commodities like gold, less so oil, but other types, silver, and those kind of hard commodities.
And finally, I just want to ask you about negative interest rates. It's possible, right? Probable, I think.
I don't know about probable, but I think we already are at negative interest rates in all but the central bank rate. So inflation is about 1 point something %, and the base rate is 0.1. So in real terms, it's somewhat negative. I think the thing about negative interest rates is that I'm still waiting for the use case that shows that it works. So I know that people are talking about it. People are talking about how it could help. I think what's less discussed is how it has helped anywhere in the past. So that's kind of my personal view on negative interest rates. I don't think that, I think it harms businesses more than it helps. I think if, for example, negative interest rates disincentivize people from saving, which is not a good thing. But at the same time, I think negative interest rates won't encourage people to spend because it gives the wrong impression about the economy. So that's not a good thing either. So I can't see the end of it, how negative would be a good thing. So either encourage people not to save, or it makes people think that the economy is so bad, so they don't want to spend.
Well, I suppose on that basis, though, so I know there's already a negative interest rate bond the government's dropped or released. But with regards to, and I understand what you were saying about in real terms, we're already there. But if the interest rates do move into negative, the question I suppose for me is, would their savers are not going to make anything. In fact, they're going to lose more. So on that basis, are those savings going to potentially come out of these savings accounts, which then has a knock-on effect to how much banks will be loaning moving forwards? And will that money be put into maybe other investment types? It might not be spent, but it may go into direct investments, because as a result of that, from a peer-to-peer lending standpoint, we're expecting to see an increase because of it, because then people can choose where they want to invest their money and potentially get better rates. So in some regard, that might actually be an opportunity, again, focused on property, but that would be maybe not such a bad thing for both investors, but also SME developers.
Yeah, I mean, if that happened, I think that would be a great thing. Because to my earlier point, the evidence for that is somewhat lacking,
Yes.
because there's nowhere that's had negative interest rates and what you described has happened. So I think in theory, and I do strategy. So theory is one element of strategy, but a large part of what I do is looking at the cases in the real world and then trying to extrapolate from that. When it comes to NRP, negative interest rate policy, one of what you just described, the evidence actually shows the opposite. So that's the theory, but the evidence shows the opposite. So economists will tell you that if you do have a negative interest rate policy, people will not save money and they will spend it. But that's economists. There are behavioral psychologists and behavioral economists who do the research, and they say that actually when you have a negative interest rate policy, people think that people go into a scarcity mindset and are more likely to hoard money than to spend it, because they think that there's bad times coming. Yeah. So you're right about the theory, but again, I'm more interested in, I wonder where it's actually worked. I'm more interested in what works in practice than in theory. I love theory, don't get me wrong. But behavioral psychology, behavioral economics is my favorite, because it actually describes the behavior of people as opposed to the economics. And we do a lot of economic studies. I've got loads of economic books behind me. But I think the behavioral side is the more interesting part. So you're right about the economic theory. I agree with that. But actually the behavioral science tell us that that's not how people behave. So you can go back. So another example is QE, quantitative easing, which was supposed to do the same and put money into from banks into the economy. But actually what it did is it inflated the price of assets. It led to an inflation in bond prices and inflation in the stock market. That's all it did. It didn't boost so many examples in tax cuts in the US that Trump did. It boosted stock prices, company buybacks, and dividends. It didn't boost income, which is what drives spending and drives the economy. So all of these things are great in principle, but I think if you do just a bit of research on the practice and what's actually happened in history, it's probably contrary to what the theory says.
And actually, that's a really, really interesting point, and one of the reasons I raised it, because there is a school of thought that if interest rates do go into negative, then obviously there is going to be more money available that needs to do something. To the point about scarcity and what people actually do, I fully understand that mindset. And it's a really interesting one, because in those situations, the fact that people are not spending or not doing anything, means that actually that's not going to, in any shape or form, help the economy, is it? To get back on its
That's
feet.
it. Yeah, that's the thing. And actually, the theory or the extrapolation goes that actually it harms businesses
Yeah,
more because if you didn't have negative interest rates and you didn't create that negative psychology, people would carry on spending as opposed to stopping spending. So yeah, I mean, I think the main thing, so the main thing negative interest rates, I guess, to give the flip side, the main thing negative interest rates would be good for is if you had some kind of credit situation where there was a freeze, a credit freeze, and there wasn't money being lent from going outside the financial system into the general economy. I think in those scenarios, negative rates help because it helps to move money along that pipe. If I look at this crisis now, I think a lot of the money is already outside the financial system, and so far as C-bills and bounce back loans went directly to businesses. It went into their bank accounts, as opposed to say quantitative easing, which is a government bond buyback program. So it puts money onto banks' balance sheet. They then decide what to do with it and how to allocate it. This time we've lent directly to the companies. So to me, the main benefit of negative interest rate we've already done in a much better way. I would call this a stimulus. So if back in 2008, in the financial crisis, austerity is what we came to know here as the only solution. But actually, around the world, lots of countries did other things. The main thing other countries did was something called a stimulus. You can look at the US and in particular Barack Obama and the stimulus package he implemented in the US, which to me is what led to their massive growth versus Europe and the UK, who had austerity, versus America, Australia, China, who had a stimulus. You can see the different trajectory, but the stimulus package in the US was so broad, so wide ranging, and that's what really led to their decade of growth that they've had since. We didn't have that. We had
right.
austerity. You're
And
going to say something, sir?
is that something that could be considered here, or is it just way too late?
No, but I guess my point is that bounce back loans and C-bills are more akin to the stimulus package than they are to anything else.
Yeah.
So last time we had austerity, we had quantitative easing, and we have all the fiscal measures. This time we've got no austerity, we've got a stimulus, and we've got the quantitative easing and all of those other measures. I think that as a package is much better than the austerity package that we got last time. So yeah, I think C-bills, unlike what we got last time, which was not putting money directly into people's
Yeah.
pockets and into people's bank accounts, C-bills are doing just that already. So we don't necessarily need negative interest rates. I would have even argued that we didn't necessarily even need to reduce interest rates. I think that we've got to a position where that's the go-to thing we do. Oh, there's a problem, reduce rates. And as we get to the end, I'll give you one of my favorite quotes is by Mark Twain. And he says that when you find yourself in agreement with the majority, it's time to rethink your position. So we're in a place now where cutting rates is what the majority does for anything, which therefore means that the market is going to expect it, which therefore means that it's not going to have the impact that you desire.
Yeah.
So if you're going to be fair, I remember, so if you recall, there were a number of measures that governments did, and every time they did it, especially in the US, every time they made an announcement, the market fell. Because the market, what they did was what the market expected.
Exactly.
So, you could do a 5 billion, okay, the market falls because they expect this from you already. That's where we've got to now. There's a lot of expectation built into the system.
But actually, the foundations do tend to be better this time. So it allows the economy, or it gives the economy a better chance of recovery sooner than in previous recessions, doesn't it?
Yeah, so furlough has been great for reducing the unemployment total. C-bills, bounce back loans have been great for keeping companies afloat. I would argue that probably a lot of the companies that needed it the most were in trouble before COVID. So hopefully we'll keep those companies. This would be a lifeline that they wouldn't have had without COVID, which is the kind of paradox of the situation, that actually a lot of companies that were in trouble already could now survive because of the pandemic. So I think overall the packages have been quite good, and it's going to help. The real challenge though is, again, even during the last financial crisis, unemployment didn't, because it was so contained within the financial sector. Then it obviously had knock-on effect into the broader economy. But because it started and really was mainly in finance, unemployment within banking was huge. I lost lots of colleagues. Some of the companies I was working for at the time lost about a quarter of their workforce.
Yeah.
So it was massive. It was huge. But this time, it's not just within banking, it's across the whole economy. It's not actually, to be fair, banks have not made anyone furloughed this time around, and they're probably not going to have any redundancies as a result of this. Actually, I think a lot of them have paused planned redundancies as a result of this. So, but whereas this time around, every other business, every other sector, every other thing is going to get hit. So I think for me, this time, the real thing to watch is unemployment. And that's, so economically, we're much better prepared, but as if unemployment spikes and if the bill to the tax man really spikes, then that's what's going to cause us longer term damage. And I don't really see how negative interest rates will help with that either.
Yeah, I agree with you. I do absolutely agree with you. I think the foundations, or in terms of what has been provided during this time, during the pandemic, has actually been quite remarkable. And if it's allowed businesses and individuals to sort of do more during this time in order just to get through it, that's definitely a good place to be. Otherwise, it would have been mayhem with the number of redundancies and business closures we would have seen potentially otherwise, let alone the health aspect of it and the challenges that people have faced on that basis. Thank you so much. I really, really appreciate your time. It's been
My pleasure.
insightful, and I think it'll be really good for listeners, or I truly hope that listeners have enjoyed it. Is there anything else that you think I've missed or you want to get across?
No, I mean, I think one of my favorite quotes is from Benjamin Graham, who wrote the book The Intelligent Investor, and he says, "The intelligent investor sells to optimists and buys from pessimists." And I think that's a really poignant quote, because we're about to get into a point in the cycle where there's going to be a combination of both. And so you'll be able to do both almost in this market. That there's a lot of optimism out there, and there's a lot of pessimism out there. So I think probably the best place to be is somewhere in between. That would be, I guess, the last thing I'd say.
That's cool. And I know that you regularly push out updates and things as well in terms of what you're seeing in the market. And so for people to connect with you through Slow Money on the Slow Money Club on Facebook, I'll add I'll add the link to the description anyway. So that's the best place for people to find you in the first place, isn't it?
Exactly. If you go to Facebook at Slow Money Club, there's a group and there's a page. You can join the group. It's a private group where we talk about all things financial analysis, property. You can also find us on Instagram at Slow Money Club on Instagram, YouTube at Slow Money Club on YouTube. And yeah, and then we have a podcast. You can go to Apple Podcast and find the Slow Money. We had your wonderful husband on one of our podcasts not too long ago. So check out the Slow Money podcast on iTunes, Spotify. But if you want to reach out to me, just go to Facebook at Slow Money Club group and send me a message.
Perfect. Thank you so much, Kwasi. I really appreciate your time.
My pleasure. Thank you very much for having me.